Hello everyone. In this video, I am going to talk about the GME stocks and its extreme volatility, and we will try to understand together what's going on. Before I talk about the day-to-day prices movement, let's look at some of the fundamentals in the GameStop, uh, and look at some of the figures. And as I speak, on March 19th, yesterday, the stock closed at $246 dollars and 90 cents with a market cap of about $17 billion. So the GameStop, the fundamentals are that they have a reasonably good amount of the sales. For example, in 2020, in the whole year, it's $6.5 billion of revenue with $470 million of loss, which means that if you compare the sales number with this total market cap, it's not looking so bad. The bad point was this: sales were not increasing over the year to year. For example, in 2009 it was even higher, and 2018 was even higher. So it was on a slowly downward tendency. So the sales were continuously going down. They had a brick and mortar old game console sales shops and so on and so forth. So as everything started moving towards online, GameStop did not keep pace with its online or digital transformation, and that's what we were looking at. In the recent time, this sales were going down. For example, from in the first quarter of 2020, it has a $2 billion of sales, and right after that, pandemic happened, and its sales were halved in the subsequent quarters. So that was also not looking. So they were predicting that GameStop is going to be dead, and that's what a lot of institutional investor, they started shorting this share down to, I think, all way down to like $15 or something, which means that it was barely like less than $1 billion company. uh, Now, one thing that that anyone cannot capture is that GameStop still is a big brand name. So nothing was preventing them to reorganize or leverage that brand name to transform this whole thing into a digital company. And even with all these losses and everything, they could probably transform themselves into a digital company. And that's a thing that sparkled more recently when Ryan Cohen, he joined in he invested some of his own money. So he became a big owner. And to give you a background of Ryan's this thing, Ryan was a Chevy, it's a pet company, Chevy owner, and he sold this company like $3 or $4 billion. And then even though the online or e-commerce thing was very very competitive, he was able to do something in this area. Now he could potentially use his background, his knowledge, or his expertise to turn around this GameStop from a brick and mortar thing to a online conglomerate. And then that could see that would mean that probably now we are looking at that this kind of the pricing for the GameStop is started more like justified. The one thing that we need to keep in mind, that this transformation to digital is going to take some effort and time, and it will happen over a period of time, if at all. And there is still some risk that there could be some bottlenecks that we don't know, but hopefully, if enough people start thinking about this, then there is a possibility that this digital transformation is possible. In the background of those financial and those few variables, let's talk about the more recent violent price movement and how do we understand this thing. So for that, we probably and heard about these terms about the short squeeze and the gamma squeeze things. And how it actually works is that we have a number of the shares in the market is limited. It's not that we have a huge number of shares, whatever they are, it's a limited number of shares. And the price, the day to day or even week to week price movement is based upon the number of the buyers and the sellers ratio. So the buyers, as we know, on the Reddit, there's a very large number of people, they gather together and they decide to own that share. And when that happens, the number of buyers increase and the number of sellers reduce. And to what happens here is the call option that comes into play. So a lot of bigger hedge funds, they understand or they have decided that this price of this GameStop cannot go up beyond a certain point, then they short that stock. Now, as the more and more people start buying those shares, they have sold it short, and they need to cover that. Now, in order that they would cover it, and that works to an extent because then they will buy it at a higher price and they eat up the whole thing, the whole loss. But there is another dynamic that comes into play, is that usually the hedge funds, what they do is they sell a call at a certain strike price. And to give you an example, let's say I have this stock call option as $246. Now what they do is that they sell a call at, let's say, $275, which is roughly the price that it is, and they trying to collect a premium of maybe $20 or something. So that's a really good amount of money. But because the stock can go much higher than 275, what they do is they buy a call at a higher price, let's say maybe $300 or maybe $350 or anything. Now that, and this call buy would be only, and let's say the call sell price at here is $25, and let's say this price, the call price is only $10. So let's see how the price is going from here onwards. If the price of this stock of a given date, for example 1 week from here, stays within less than 275, or it ends up less than 275, they pocket in $25. But they want to protect themselves if the stock price goes much above 275. So let's say the stock price starts going up and up and up, and then the stock price move to, let's say, $400. Then in order for, if they would like to be protected in that, and what they do is they buy a call of $300, which gives them the right to buy this $300 stock at $10. So by doing so, they limit their losses. They reduce their profit by $15. So instead of $25, they will buy it at $10. But it also prevents them from a significant amount of the loss that would have happened if the stock price would have gone much higher. But here is the thing that makes this stock price move violently upward. Now all of a sudden, all of those call sellers, they turn into call buyers, which is pushed an upward moving pressure on the stock. So all of them now are buying call higher, and then if there is any more short seller, they will be buying calls at an even higher price. So we see that this feedback mechanism starts working, and then they have to buy call at a higher and higher and higher prices. Eventually all those stocks get bought at higher and higher prices, and that's how the stock prices keep going up. Now how high it goes, nobody knows where it can end up. The one thing that is for sure is that it cannot go indefinitely, because as this market capitalization increases from $17 billion to say, let's say, $100 billion, then we need to incrementally, to make it further move, you need a much bigger amount of money, and obviously that is not going to happen. That's my gut feeling, is this thing. At the same time, here is a lesson for the people who try to short the stock, and that's what I make a principle. And that principle is that don't try to short a stock which has a smaller overall market capitalization. Try to short only those stocks that have a much bigger market capitalization, and that means that they typically want to short the stocks which has a total market capitalization of at least $50 billion, but if possible more than $100 billion. For example, even though it's not a great example, but it to reduce your amount of the losses, it's probably okay to short Apple at this point of time, because it's a $2.3 trillion of stock, and then if you, the chances of doubling from $2.5 trillion to, let's say, $5 trillion is much less, which means that your amounts of losses would be limited, if at all. But if you in short a stock which is $17 billion, it can easily become $34 billion, and then your losses would scale. So you need to probably, some of the good examples for shorting could be, for example, Snow or DoorDash. Those are 30, 40, 40, $50 billion stocks which are reasonably big, and they, I don't see that a very big future in the near term from them, and so on and so forth. So hopefully I threw some light into GameStop. And then one thing I cannot recommend at this point of time is buying a GME stock as well. It's going to be highly volatile, and we don't know which direction it would take, and it's very hard for me to predict that as well. Thanks for taking a look.